Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate expert and principal of VanWest Partners, Jacob Vanderslice. Now, VanWest Partners is a Denver-based real estate investment firm focusing on the acquisition and management of self-storage centers and other opportunistic commercial real estate throughout the United States. And they have now done over $195 million worth of commercial real estate transactions. And so, guys, without further ado, I'd like to welcome our guest for today's show, Jacob Vanderslice. Jacob, how you doing, my friend?
Kevin, good to see you. Thanks for having us on today.
Yeah, excited to have you here, bud. And I know we were chatting a little bit before we started recording just about all the different things you guys have going on, but I'm excited to dive into all that and what you guys have happening at VanWest. But before we do, maybe I gave you such a brief bio. I know there's a lot more to the story. So maybe take a few minutes, tell our listeners a little bit more about yourself and ultimately how you found your way into the real estate space.
Well, we got started about 15 years ago as full-time real estate investors, primarily doing single-family rentals and fix and flips. We've done over 1,200 over the years, and that was a good business. It's tough to replicate and scale. We kind of migrated into commercial real estate in 13 and 14 with adaptive reuse retail projects around Denver, which is basically converting old brick warehouses into multi-tenant experience-based retail concepts like breweries and restaurants and gyms, yoga studios. We've sold some of those off and held on to others. Those have been really the most fun projects we've done over the years. They're an absolute blast, especially the historic aspect of some of these buildings. And then we got into self-storage in 2015. And we like the asset class because it's been historically recession resistant, defensible, durable cash flow and income streams. And we started off with ground up development. We built a number of properties here in Denver as part of a co-GP arrangement with some high net worth folks. And then we scaled up the business into the Midwest, did a bunch of deals in Milwaukee. And as of today, we own 30 self-storage facilities, just over 150 million in 8 different states. And we've historically done single asset syndications. We launched our first fund back in 2019 for self-storage. We closed that fund out. And we launched our second fund early in 2021. And our capital raising target's 30 million in equity. We're about a third of the way through that. We've bought 7 properties so far year to date. So yeah, we're mainly focused these days on self-storage and cash flow.
Okay, very exciting, man. That's quite the background, and especially doing 1,200 fix and flips. That's a lot of transactions, man. I way back in the day I did the same thing, and that is an incredibly difficult business to scale. And I give massive kudos to folks like yourself that actually got it to scale, because there's a lot of moving parts to that business. Not that there's not in self-storage or other types of commercial development or investment, but the fix and flip game is it's a different breed. It surely is. So
it's very transactional, and we've been focused on being less transactional the last 5 years and more long-term holders. It's a great business and we love it. And even if we want to do it still, deal flow and pricing is so challenging. It gets worse by the month.
At least in your backyard, right? In Denver, it's probably nearly impossible actually. Well, I guess you could play the musical chair game, right? And like buy high, improve, sell even higher, and just assume that you're going to keep going up and up, and
just keep riding the wave until the wave stops. Yeah, exactly.
Yep. Music stops at some point in time. Well, let's talk about your decision to ultimately when you're kind of you got out of fix and flip, started doing these retail projects, and then we're looking for something different. Was self-storage always on the mind, or did you look at other asset classes and finally just land on self-storage based on the underlying fundamentals? I mean, give me kind of that thought process and how you landed there.
We had looked at self-storage for a number of years. One of my partners, Wade Buxton, built a facility in California with his parents back in high school that his family still owns. So he was our self-storage experience, a high school kid driving a backhoe for grading back in California. But we had studied it quite a bit. We thought we were overdue for a recession even back in 2015. And it turns out everything kept going, and it continues to go, even with what happened in the last year, at least in a lot of asset classes. So we wanted some more downside protection and that proverbial kind of moat of cash flow. And we believed that self-storage was a good asset class that we could actually scale and repeat. I mean, we're leasing out metal boxes. And whether you're doing it in Florida or Colorado or Illinois or wherever, it's a pretty similar business plan every time. Unlike our adaptive reuse retail program, where it's very hands-on, very renovation intensive. You have to really get to know your tenants well, and arguably kind of a higher risk profile. So we like the lack of risk. We like the cash flow, the repeatability, and the scalability. And that's why we focused on it. And it's gone well so far.
Good deal. And for the most part, existing properties for acquisitions, or are you guys doing new builds in the self-storage space?
And there's really three types of storage deals. The first is ground up development. The second is a reposition from a prior use into self-storage, whether it may be office, big box retail, or industrial. And the third is just value at existing facilities. So we've done all three. In the last couple of years, we've done a few single asset syndications outside of our fund structure that were conversions. But by and large, in our two funds, we're only focused on existing self-storage facilities where we can add value with capital improvements and operational efficiencies. We like that cash flow from day one, and we like to be able to make distributions on each property from day one. And the heavier value add deals like a reposition or ground up development is a big yield drag at the fund level. So we keep those out of our fund and only focus on deals with good income that's already in place.
Talk to me about the conversions, the readaptive use of, maybe a big box store, what have you. What are some of the, other than the yield drag, what are some of the other downside risk associated with that type of deal versus a value add existing storage facility?
Yeah, the first risk really, especially with a big box retail conversion, is zoning. Often cities do not allow storage for a zoning use in that parcel. They want a retail user to come in because of the sales tax revenue. So those are kind of tough to get done. Guys get them done, but they're kind of few and further in between. Then whether you're converting an industrial building or a big box retail building into storage, I think the primary risk is that you're forecasting out your lease rates years down the road. So you're going from zero income in place, to whatever your pro forma suggests. And the pro forma will tell you whatever you want it to, right? So you got to believe the rates you put in there. And the only consistent thing about our models is they're always wrong. They're either wrong in the right direction or wrong in the wrong direction, but they're always wrong. So yeah, the primary risk is forecasting not only what that revenue stream is going to look like years down the road, but your lease up velocity. You might assume you're going to lease it up and stabilize it in 18 months. And if it takes 36 months, that's a material delta on the value creation strategy and the time it takes to create that value. So I think just the revenue forecasting is the main kind of risk there. Self-storage leases are all month to month. So if you're doing like a triple net industrial deal with Amazon, for example, you know exactly what your dividend yield is going to be for the entirety of their lease term, assuming they pay, which they probably will because it's Amazon. And self-storage, forecasting out those revenue streams for 10 years is tough because they're very dynamic. People move in, they move out, rates change based on the seasonality of the submarket. So that's really your primary risk. And we try to reduce that risk by buying deals with historic rental data. So we know that leases have done this the last 2 or 3 years. We think we can bring rates up to market, but if we can't, we know that our income stream is going to stay steady, hopefully not get worse than it was before we bought the deal. So it's kind of a nice risk mitigant.
Yeah, no, absolutely. And, I like to compare just more from a fragmented ownership standpoint and the consolidation that's happening. It's two similar factors with manufactured housing, which is what we're in, to self-storage. And in both of our spaces over the last, I call it 5 years, probably sooner in your space than it was in our space, to where some of the really big players and private equity started really diving in, head first. Ultimately, our space has really picked up over the last couple of years with, the Carlyle Group, Blackstone, Apollo Group, and what have you, putting just billions upon billions of dollars into a space that has limited supply. And so that's one of the big differences with us, is we've got limited supply. More parks get torn down or redeveloped every year than they get brought online. However, in the self-storage space, that's not necessarily the case. There's a lot of new supply coming onto the marketplace. And so how do you guys manage, your forecast when you've got this inevitable competition that's coming down the pike, whether it be today or 5 years from now, with there not being a lot of barriers to entry outside of zoning restrictions in any particular marketplace? How do you guys manage that forecast process?
Supply shock is a major risk in self-storage, and there have been a lot of markets in the country over the last couple of years that saw some major supply shock. Denver was one of them. Seattle's another good example. Miami's another good example. A lot of people had the same idea at the same time. And self-storage is very local supply sensitive. So we'll track supply ratios in the 1, 3, and 5 mile trade radius. And nationally, there's about 7 square feet of self-storage per person in the US. Once you're getting up towards 10, you start to see a decline in occupancy and rates. And when you get under 7, it becomes a little more stable. Now, you can't completely, of course, mitigate the risk of new supply. We try to look at building permits, zoning. We try to see if the municipality is averse to self-storage development or okay with it. That's kind of a subjective and objective data point to a degree. But our primary line of defense in mitigating the risk of new supply is focusing on acquisitions where we can be all in at or below replacement cost. Mm-hmm. So if a new competitor shows up a mile away, their rents are going to have to be incrementally higher than ours, commensurate with their incrementally higher cost basis to achieve the same total yield on cost. Basically, they spent more money on the facility, so their rents have to be higher. So we generally try to be the low-cost provider. But with all that being said, though, we can't completely insulate against a public storage building a 100,000-foot bomber across the street from one of our deals.
Right. Got it. No, that makes sense. Talk about automation and how that's playing into the self-storage space. That was something that always just, it attracted me to that sector. We had actually looked at developing self-storage back prior to the crash. We even bought a couple of 5-acre parcels. This is like 2006, 2007. And ultimately, neither one of those ever got out of the ground. But I spent a lot of time going to the different association meetings and just learning the business. And one of the things that was really, it was just getting speed back then. I mean, we're talking now, 12, 13 years ago. It was just getting traction back then. And it surely wasn't the norm. You heard about a few facilities here and there that implement automation as far as the gates and access points and what have you. But where is that at today? I mean, do you guys utilize automation in your facilities, or do you still have, an actual physical person on site there that handles signing the agreements, letting people in, letting people out, what have you? How does that work within your Clear Home facilities?
Yeah, I'll start with our staffing first, and then we'll go to the automation components. So if we have 3 types of deals as it relates to staffing, we have some deals that are not staffed with a full-time on-site manager. There's someone nearby at a satellite location who can go over there and do quality control checks and repairs and maintenance if needed. We have other deals that are staffed with a part-time person in the leasing office who's not there full-time but part-time. And then we have deals that have traditional staffing loads, full-time on-site manager. Those are our bigger multi-story climate-controlled facilities. On the automation side, though, whether it's a single-story drive-up deal or a multi-story climate-controlled facility, you can lease your unit online, get your gate access code online, sign your lease online, move in, make your payment, move out. So if you don't want to talk to a person at any of our deals, you don't have to. Now, we experimented early on with completely remote management with basically a 1099 employee going by to do repairs and maintenance and quality control checks. And that didn't work that well from just a keeping the facility up to par perspective. So we believe the automation really helps our operations out and makes a more seamless leasing experience for our customers. I mean, all of our gates are connected to the internet. We can see all our camera systems from the office. We can open a gate right now in Florida from Denver on our smartphones. We can see who's come and gone. But even with all that automation and technology, you still need boots on the ground. Just like any real estate deal, bad stuff sometimes happens, right? Someone sleeps in a unit, someone's keeping their drug stash in a unit, stolen vehicles, theft issues. You just need boots on the ground to help mitigate that. So the automation really augments our management platform, but we don't rely on that completely to execute our strategy.
We just queued up a great question. Give me the craziest story that you guys have witnessed or experienced while in the self-storage space.
Let's see here. There's been a couple of them. We didn't appreciate how much of an issue we would have, especially in our infill locations with people sleeping in units, especially deals that have more liberal access hours. They'll come in, they'll pull their door down, and the facility closes up at 10, and the guy plugs his smartphone into an outlet nearby and sets up camp in his unit. I'd say the biggest one that comes to mind, we had a drug dealer with a stolen U-Haul in one of our units, and our owner user office building just south of downtown Denver has office upstairs and self-storage on the main floor. Very small net rentable square footage footprint for the storage, but it helps offset our overhead. But this guy he had a rap sheet, 10 pages long, and the cops were aware of him. The cops told us to call him up next time he was here. So he was here. We told the cops to come by. So 4 squad cars show up. They get out with their guns pointed at this dude. And we're all watching from the window, like a bunch of, Garfield guys glued to it. And the guy sits there. He sees the cops come in. He quickly reaches in his pocket, and we're thinking this is not going to go well, and pulls out a meth pipe and throws it over the fence. And we're thinking, cops probably going to see you throw that meth pipe over the fence. They're going to know it's a meth pipe. You're lucky you didn't get shot, thinking it might be a gun.
Yeah.
So they took him down to the parking lot, arrested him. We had a guy once order a pizza to his unit. A pizza delivery guy showed up to our office all confused. And this guy just set up a mattress and ordered Domino's to his storage unit. So stuff like that happens.
That's pretty impressive, though. You got to give the guy a little bit of credit, right?
That's right. No, good for him. Good for him.
Awesome. So talk to me about finding deals, right? We're in a highly competitive, not just self-storage, not just manufactured housing, basically every sector of real estate, lots of capital chasing yield out there. everything's inflated in price. Everyone's running after this yield, and people have money to spend. And so, how are you guys finding deals today? I think, was it 4 deals that you've done since the beginning of this year, or was it 7? 4, 6,
7. Yeah, it was
7.
2
Okay.
portfolio acquisitions. One was 5 deals, one was 2. Deal flow is becoming increasingly challenging. If it's a deal that's widely marketed with best and final, we're not coming anywhere close. We'll write offers on almost any deal that will fit our acquisition criteria, which is occupancy and cash flow and demos. But I think we had $50 million in LOIs out in a given week and didn't get close on a single deal. So I use this term cautiously because it can kind of be hokey, but most of our stuff is sourced off market. Sometimes an off market deal is a bad deal. But when I say off market, we have good broker relationships. We'll get a lot of deals before they actually get actively listed. We'll strike a price with the broker and the seller that makes sense. We'll go under contract and we'll close. So our Michigan portfolio, which is about 20 million, was sourced off market. And the same with our 2 property portfolio, 1 deal in Columbus, 1 deal in Florida. I think over 70% of our deals in Fund 2 have been off market, at least between our deals we've closed and our deals that are in the pipeline. Yeah. And sometimes when we buy a marketed deal, it might be a deal that's poorly marketed. Maybe it's a residential broker. Maybe it's unadvertised very well. Maybe we heard about it first somehow. We do a little bit of direct to seller marketing that we learned from our single family days. We did a direct mail piece a couple of years ago, and we placed about $10 million off of it between 2 deals. So really it's broker relationships and a little bit of direct to seller marketing, but deal flow is much more difficult than it was a year ago.
We sound very similar in nature. Yeah, we do a lot of direct owner stuff, but off market stuff through brokers before it goes out to market. But ultimately, anything that goes to market, we'll make offers on it, but we fall very, very short. I can tell you that we have not bought anything from a broker that was listed, open marketplace in the last probably 2.5 years.
Yeah, we were off by $2 million on a deal that we recently offered on, just way off. And I don't know what the math is. These
proportionally,
buyers,
what percentage is that from where?
I think we offered 6 and it went for 8. So pretty big chasm there between the strike price and our offer price.
Yeah, we just lost one that traded for just shy of 17 million, and we offered 13.5. And I tell you, I was stretching. I really was stretching because there wasn't a lot of additional upside there to be had. It was a good market. It was actually a really good market. But we were talking about this before we started recording. I know there's probably better operators. You guys are good operators in the self-storage space. There's probably folks that do it slightly better than you. I feel like we're good operators in the manufactured housing space, and there's surely others that do it better than we do, right? I'm not going to ever say that I'm the greatest. I think we're really good, but surely, again, there's always someone that can do it better. There's always someone that could squeak out some profitability in an area that I might not have seen. But what are, speaking to your sector, self-storage, the ones that you're losing out on, what are the other buyers? What do you think they might be seeing, or what do you think they're seeing as far as path to profitability? Or is it I know that in the manufactured housing space, I've seen a lot of buyers come into the fray that are just really playing the consolidation game. They're literally just trying to buy everything in certain regions and ultimately think that they're going to, and I hope they do, that they have some type of cap rate compression due to the size of the portfolio, and then basically hand it off to a REIT and call it a payday, right? I think that's a risky game to play. But what are you seeing as far as those buyers that are really not necessarily overpaying, but beating you out on these on market properties?
Yeah, well, like you, we're not entirely sure how they're making the math make sense. We'll, within reason, we'll push our assumptions as much as we can believe we can execute on. And when you're $2 million off, you're like, what are we missing? Mm-hmm. I think a lot of it's a lower cost of capital. I think a lot of it's consolidation, like you mentioned earlier. I do believe there is real cap rate compression with a bulk portfolio sale regionally and maybe nationally. We're not going to rely on that, though, for our disposition strategy. We're going to rely on a cap rate or valuation that the deal can stand on its own with.
Yes.
I also think one of our challenges on our deal flow and acquisition side is our deals. We're trying to blend good dividend yield with capital appreciation, and it's tough to do both of those. It's tough to get into a deal that's going to pay a levered 8 or 9 dividend out of the gates with maybe a additional upside down the road when you sell or refinance.
Yeah.
I think a lot of buyers are just focused on, all we want is a yield. We want a levered 6, and we want to get our money back after 10 years. Mm-hmm. And we can't compete with that. Yeah. So, I'm not sure what those models look like, but it'd be, I wish I could see them because it'd be fascinating to compare them 5 years from now against what actually happened.
I think you're right. I mean, I think I'm guessing the majority of your capital comes from high net worth accredited individuals. Is that assumption right?
Yep, exactly.
Okay.
Yep.
So your cost of capital, I mean, there definitely are other groups that have a lower cost of capital if they're getting, for example, getting their money from a pension fund. I mean, their cost of capital is significantly different than URI's cost of capital. So I do think that that is another factor in the equation of those that come in and you'll get to, you and I might be overpaying, but to them, ultimately the numbers are working one way or another. So yeah, I guess
Yep.
we'll find out in the long run, right?
And they've got a large capital allocation they have to deploy, and
Yeah.
it's burning a hole in their pocket. They have to buy something to get some kind of yield.
Let's talk about Clear Home. So that is the actual national brand of your self-storage company. Talk about the importance of actually creating a national brand. Why not just, brand each one individually and call it a day? Is there power behind the brand? Is there leverage that you guys gain from having the brand?
Well, let me briefly touch on the evolution of Clear Home first
Sure.
and why we kind of got there. So, as you know, property management is painful. It's the most painful aspect, I think, of any of our businesses. It's tough to do, and I'm sure it's the same with mobile home parks. We used to outsource our self-storage management to the national REITs, thinking they're best in class, their call center, their revenue management practices, their marketing, everything is just better than we could possibly put together. And we found over time, after the honeymoon was over, that to a large degree, our interests were kind of misaligned. So, for example, they'll park a $30,000 marketing budget on a given facility, but they can't defend that those marketing dollars are directly driving lead traffic to your location. It's some sort of calculation in their office that says, okay, we spend this much across the country. Your facility is this many square feet. You're still benefiting from it, but they can't point to say, 30 grand equated to this much revenue in as a result of the marketing effort. Another thing we found too over time was there's a lot of ancillary revenue streams in self-storage, specifically tenant insurance. It's almost like car rental insurance, which you probably always decline and your listeners do because you have coverage in your auto policy, your credit card, but a lot of people buy it. And the net income on that insurance revenue is pretty extraordinary because the cost of it's very low for the carrier. So a couple of the big REITs keep all the tenant insurance revenue. And we found that over time, we were seeing a little more depressed base rent rates because of the insurance premium being loaded on top of that. And again, we're getting the rent after their management fee, of course, and they're keeping all the insurance revenue. So after some number of years, we concluded we need to self-manage these things because we're going to align ourselves better with our partners, and we care more. Owners care more than third parties. So we formed Clear Home about 3 years ago. And to return to your original question of the branding, I think the branding consistency is a data point and it's meaningful, but people care about really three things in self-storage from the customer side. It's clean, safe, secure. It's got to have those three things, and pricing. And if it's conveniently located, it's a rational facility, and your unit's $20 less than the guy a mile away, they're probably going to come see you versus your competitor. But the branding consistency, we haven't really measured on how important that is versus naming each facility, its street name or whatever your naming convention might be. But when you start to cluster and you start to get geographic concentration, that's when the branding matters more. Yeah. In our limited experience so far on the management side the last 3 years, I think it matters less from a national perspective. But when you have 5 Clear Home facilities, for example, in the Florida Panhandle, you start to get some brand awareness. Yeah. And you can kind of shift customers between facilities based on what their needs are. Maybe you don't have a 10 by 10 available at one location, but you can point them to a 10 by 10 a mile away and give them a discount. And that's worked out.
Yeah, no, it's great. And I'm assuming, again, I don't know what your long-term strategy is, but if you guys ever intend to exit out of the self-storage space, it's a nice, neat package with a bow on top with your property management arm and your facilities all branded the same for a REIT or a large institutional player to come in and scoop it all up. So I'm assuming that would be much more attractive than individually branded sites in multiple different states and markets across the country. Again,
certainly, but like you, we're not looking to sell.
You're right. Yeah, we talked about that.
Yep,
you guys are long term. I think we're very aligned on many things. Yeah, as we were talking about earlier, it's a lot of similarities. Even the whole outsourcing the management. We did a little test phase with the best in class manufactured housing management company. They manage more than anyone else. They've been in the space 40 years, yada, yada. And it was an absolute disaster. It was not good at all.
I'll tell you, we're not best in class, but we care the most.
Yes,
for sure.
Yes, absolutely. No, I agree with you. So let's talk about the long-term strategy. What is it? I mean, what decade, 2 decades down the road, like what is the plan with VanWest and your, more importantly, I guess the question really pertains to Clear Home. What does that long-term strategy look like?
Well, right now, ClearHome only manages our existing portfolio. We might look at third-party management years down the road, but it's not a priority right now. We just like to focus on the deals we actually are partners in and we own together. In terms of the long-term strategy for our storage platform, our most recent fund life expectation is 6 to 8 years plus. There's not a defined exit period.
Mm-hmm.
So what's exciting for us the last 3 years is we focused really on being a lot more focused on income and recurring revenue streams, and less so being focused on transactional revenue streams. And we think storage is a great vehicle to build long-term, repeatable, durable cash flow streams.
Mm-hmm.
Obviously, you have to underwrite some sort of return of principal to your capital base. And we are underwriting that. We're assuming a one-off disposition of each facility starting on year 6 in our most recent fund at what we believe is a fairly conservative cap rate, but I can't look you in the eye and you can't either and tell me where cap rates are going to be in 7 years from now. So we're really focused on the income along the way. And the way our capital structure is, any excess income above and beyond preferred return goes to return investor capital accounts. Mm-hmm. And then once their money's back, they're still getting ongoing distributions, whether it's from operational income, refinance proceeds, or a sale. Mm-hmm. So we're more of a medium long-term hold. The consolidation and the cap rate compression is always in the back of our minds. There were some big storage trades in the last year, specifically Blackstone, who's also in the mobile home park space, bought Simply Storage for $1.2 billion. And I think the implied cap rate on that was somewhere in the low 4s, which is extraordinary. So we'll see where the market's at down the road. But if you stabilize your deals to a 9 cap and you can somehow sell it a 4, I tell you, I'm a terrible seller, but that might get us over the hump.
Yeah, there's always a price, right? There's always
always a price. Yeah, there's always a price. But then you got a tax bill, you got a return of capital, you got a new round of risk to redeploy it. So time will tell.
Yeah, there's complications on both sides for sure. I'd like to switch gears real quick, Jake, if we could, before we wrap things up here. And most challenging deal of all, and it can be, you've been at this now for many, many years, from, fixing and flipping to, the readaptive retail projects that you had there in Denver to self-storage now on a national scale. Most challenging deal that you've ever been involved in as a principal. It could be maybe a bad partnership, maybe you lost money, expectations fell incredibly short for whatever reason. Again, what was the deal? Where were the problems? And ultimately, what would you have done if you had to do it all over again?
Well, I remember the failures so much better than I remember the successes. I could go on for an hour about the failures over the years. One that comes to mind was back in our residential days. We used to buy all of our deals at the trustee sales. Mm-hmm. So you would pull an O&E telling you if you're buying a first lien or not. And sometimes we would buy second liens on purpose because we could use that second lien to redeem the first and get into the deal. So we bought a second lien on a deal at the trustee sale. And you can't get a payoff, obviously, because you get these bids out, 24 hours ahead of time. So we estimated the payoff if the guy hadn't paid his mortgage for 2 years on the senior lien. So we had a conservative number. Okay, this deal still works. It turns out the guy had not paid on the mortgage for 10 years, and somehow they just now had foreclosed. So we bought the junior lien. We get the payoff figure after our money's already out. And it was a massive delta. And then in addition to that, the deal had some really bad structural issues that weren't obvious on our drive. But once we got inside, it's like, wow, this is bad. So our options were, and it was just me and my partner's money. Our options were, we could rehab it and hope to break even on a great, great day, or we could sell it now and lose 50 grand. So we sold it now and lost 50 grand. So that was not a fun one. Another one we did, again, not self-storage, but we decided to build a house out of shipping containers. And our thought was, we can build it faster, we can build it cheaper, and we're going to do 10 of these a year and, assemble them on site and just kind of turn through these things. And it turned out it was substantially more expensive than stick building and took substantially more time. And we lost money on that deal. And I don't know what my learning takeaway is from that, other than don't build a house out of containers again.
Yeah.
But there's a lot of guys out there who have figured out how to do it the right way and in scale. But we certainly encourage experimentation, and sometimes experimentation fails. Those are two that come to
Yeah,
mind.
no, that's great. I appreciate you sharing that. I'm sure just like in the mobile home space, if you could do it in a controlled environment and at scale, I'm sure there could be a good bit of cost savings. But doing it like on site, just like you would a stick build, but ultimately having the container there and actually doing all the framing and all the other aspects of the build, I could see where it could get out of control fairly quickly. But I bet you look cool. I mean, you have some good. I bet you it's good stories and good response you got from the marketplace once you're done with it.
Yeah, no, we sold it for a pretty good price.
Yeah,
I like to say that we never have a bad deal. We just have deals with a basis problem,
yeah,
and
yeah,
this
yeah,
deal
yeah.
definitely
I
had a
like that.
basis problem. But
I like
it's
that.
our of all the the marketing that we've done and the podcasts and webinars we've done, the highest count we have is the assembly video on the shipping container house. It's had over like 200,000 views on YouTube. It's like
That's
it's
awesome.
like
I'll
a
have to go
fast
check it out.
forward. Yeah, I'll give you the link offline. You can
Yeah, it'd be
entertain
great, guys.
yourself.
I'll put it in the show notes as well because I definitely like to check that out. And then, kind of on the same line, everyone always talks about the deals they did, the deals actually they closed on, but right, there's always deals along the way that you tie up. They look great from the outside looking in, and then ultimately, for one reason or another, whether you get into third parties or you don't even get that far along, you get your due diligence packet, you see deeper financials, you see account, age receivables, whatever it might be, and something scares the heck out of you and makes you turn the opposite way and kill a deal. And we're not one to tie things up. That's not our objective. We're not one to tie things up and then that basically walk away from the deal or not close the deal. But it happens, right? You're in this business. It happens. Is there a point in time during your, and we'll speak self-storage, because that's really your core competency today. Is there a deal over the last couple of years that ultimately you guys got into, were super excited about, and for one reason or another, you decided to walk from it? And if so, what were the reasons?
We had a deal in Louisville, Kentucky that we were very excited about. It was a 2-property portfolio. I flew out there to check it out before we were about to go hard on our money. Our bank financing was getting close. We were very excited about it. We got a zoning report that came back that basically stated a lot of the units were a non-conforming use on one of the parcels. So we tried to negotiate with the seller. They weren't very receptive to that. There were also a lot of down units that we did not expect. So basically many more units than we thought had water damage, whatever kind of damage you might think of. We asked for them to fix that. They wouldn't do that. We got in a knife fight with the seller. We had to get attorneys involved. We ended up settling. They wanted to keep our earnest money, but we couldn't close the deal because of that. And it was the right decision. It was the right decision to lose some money on legal fees in our deposit to not buy a bad deal that had the risk of having a major non-conforming use issue. But in the back of my mind, being a real estate entrepreneur, I wondered to myself, oh, maybe we could have bought it and powered through it and figured it out with the city. But that was a painful one, not only because we were ready to close and the pro forma was very conservative and still shows some very good numbers. But sometimes you just have to walk away.
Yeah.
And if walking away involves losing money, it's a small price to pay for getting yourself into a deal that you're going to wish you didn't buy.
Yeah, absolutely. Was it legal non-conforming or illegal non-conforming?
It was an illegal use based on the city zoning code for parking and some of the storage units.
Got it. Okay. I was
Yeah.
saying, because we deal with non-conforming uses all the time in the manufactured housing space, but they're legal non-conforming, so they got grandfather protection. So this doesn't sound like that was the case here.
Yeah, our legal team did not have that opinion.
So you would have lost rentable space, is what would have happened.
Yeah, and as you know, commercial real estate is so sensitive. It trades on an income of the multiple it produces, and if you lose 10,000 net rentable square feet out of 50, that's a huge impact, right? Massive impact. So we just thought the risk wasn't worth the reward, so we punted and took some lumps, but bought a lot of deals since then, and things are going well.
And I'm assuming the seller in that, from their standpoint, they're probably like, well, I've owned this for X number of years, and we've never had an issue, right? And fair enough, you haven't, but ultimately, someone's going to have an issue at some point in time, and I don't want it to be me.
And we found out later that the seller is notoriously litigious as well, like widely known. So we didn't know that going into the deal either.
Yeah. Awesome.
It happens.
Yeah, absolutely. Well, I appreciate you sharing that and just being vulnerable there and talking about some of the bad sides of just being in the business, right? I mean, it happens. You run across strange transactions, challenging transactions, deals that ultimately you're excited about and they don't work out, what have you. Many different just hurdles along the way. For those folks, Jacob, that want to learn more about what you got going on, whether it be your website, your fund, new transactions, what's the best place to reach you and follow along with what you guys have happening?
Yeah, we love to connect with folks. If you have a deal, you want to invest, you want to learn more about storage, we're happy to talk. You can go to our website, vanwestpartners.com. You can email me, Jacob, Jacob, at vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice.
Good deal. Jacob, it's been a lot of fun, man. I enjoyed having you here. Appreciate you coming on the show today, and look forward to staying in touch and following your progress.
Kevin, we appreciate it too. Thanks for having us on.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.